Hello everyone, it's Steve with Aptera Owners Club. Today is Friday, March 26th, and the markets actually did quite well today. And actually, they've been doing well for this week. As you can see, this is January of this year, and it's been a kind of a continuous downturn until this week. And this week has been an upturn. Now, who knows if it's going to be an upturn like this where it heads down again? We don't know. If I could predict that future, I'd be moving some money around. But anyways, in this video, I wanted to actually go over a report by Sequoia, which is a huge venture capital group, and do a brief overview of the market. Here's some of the EV stocks that we've been watching. They've had a great day today, led by Tesla, which is up 7.3%, and then most of the other EV groups are up about 5%. So Canoo, Lordstown, Fisker, Rivian, Archimoto is up 2.5%. Solo is down, is the only EV stock that's down. Sono Group, which is the other EV from Europe, is up 8.7%, but of course they're pretty pushed down at $3.2 per share. And then Lucid is about up 5%. If you invested in this stable Terra coin, I'm sorry, that thing is still crashed. And Bitcoin is actually going down and it's decoupled from the market, which is interesting. I never got into crypto, but I know a lot of people did. I've been just kind of following it out of interest. But anyways, the markets have done well this week and the EV stocks have done well today. But what really caught my eye was this article that came out today. And venture capital firms have very bad news for startups. So Sequoia Capital and Y Combinator have told startups that cutting costs is a priority. And so Sequoia Capital, if you guys don't know, is a very large venture capital group. And they sent a 52-page slide presentation a few days ago to their founders that they are investing in. And Sequoia has been around since 1972 and has invested in, Google, Uber, Airbnb, Square, Instagram, WhatsApp. So they have a long track record. They're a very successful venture capital group. But anyways, I was very interested in what they said, so I tracked down this document that they sent out to their founders, and I thought we would peruse it together. If you find that interesting, stick around. If not, you can skip the rest of this video. But I just wanted to read through it. So this is the PDF of the thing that they sent to all the founders. So we're just going to peruse this pretty quickly. I'm not going to read the entire 52-page argument document. All right, so I guess whoever's writing this thing was CFO at PayPal. It was March 2000, and then they were valued at 500 million at the time. A month later, the Nasdaq experienced a sharp decline. Okay. So they decided that that's when they were gonna keep going. Eventually reached 250 million revenue in 22, profitable and generating cash, market cap north of 1 billion. Today, PayPal is worth 90 billion. All right, so he's basically saying this is not a time to panic. All right, here we go. All right, so I think this is not okay. So this is I think the important stuff. We foresaw some of this when we first published our Black Swan memo at the start of COVID in early 2020. What we got wrong was monetary and fiscal policy response that followed and the distortion field that it created. This time, many of those tools have been exhausted, and sustained inflation and geopolitical conflicts further limit the ability for a quick fix policy solution. As such, we do not believe that this is going to be another steep correction followed by an equally swift V-shaped recovery like we saw at the onset of the pandemic. Yeah, so if you look at this was the onset of the pandemic. There's huge decline, and then it rebounded within a year, actually. So it had a very steep climb. So they're saying they don't expect that to happen this time because all the fiscal policy response that people did has been exhausted. So we no longer have those tools. All right. So I think this is looking at what the Federal Reserve has done. So at the start of the thing, they bought a bunch of Treasury securities and mortgage-backed securities. I think they even bought bonds. So you see this huge uptick here. They bought a bunch of stuff. In response to COVID, governments around the world embarked on a combination of extraordinary fiscal and monetary stimulus to fill a massive demand hole created by the pandemic. This helped prevent an extremely severe recession, but came with consequences. During the pandemic, this money printing revealed itself in asset prices, especially in companies perceived to be beneficiaries of themes like remote work and e-commerce acceleration. Okay, yes. As the economy reopened, this liquidity creation manifested itself in bottlenecks and distortions throughout the real economy, leading to supply chain challenges and price pressures as demand overwhelms supply. That's why we have inflation, when there's too much demand and not enough supply. Inflationary trends have accelerated since early 2022, with the war in Ukraine exacerbating the supply chain complexities and commodity price squeeze. At this point, we've all seen the various charts showing inflation spiking in recent months. More important than the moment in time inflation is the increasing long-term expectations for inflation as expressed by the bond market, where 5-year forward inflation expectations are at the highest levels in decades. So I guess what they're saying, if I understand this correctly, is that the bond markets are indicating that financial experts are thinking that inflation is going to be continuously high for the next 5 years at least. That's pretty grim. The new Fed mandate control inflation, tighten liquidity conditions. This matters because Federal Reserve has two jobs: maximizing employment and manage price stability. Inflation running high and sub 4% unemployment fueled a growing perception of economic overheating, an increasing sense that Fed was underperforming on the key pillar of its mandate. Then the Fed pivoted to tighter money. This chart shows expected for the year-end Fed funds 10xing since September, as the expected number of rate hikes in 2022 went from sub 1 to greater than 9. This implies an abrupt increase in the cost of money and tightening of economic conditions. Beyond hiking rates, the Fed is also planning to shrink its balance sheet, further contracting liquidity in the system. All right, well, I'm not a financial expert, but what I get out of this is we know that the Fed's job is to maintain inflation at a certain rate and not let it overheat. The main tool they have is increasing the Fed interest rate, and they are planning on increasing their interest rate. So you can see that they did not increase interest rates, and then about here their slope of increasing the interest rates has gone up significantly. So, and then they're planning on not buying any more securities, treasury securities or mortgage-backed securities or bonds. So that's going to further contract liquidity in the system. So there's going to be less money flowing around. Capital was free, now it's expensive. Okay, when capital is free, the best performing companies were capital consumptive. As capital has gotten expensive, these have become the worst performing companies. What are the implications of capital being expensive? Given every dollar is more precious than it was, how are you going to change your priorities? We are just now beginning to see the increasing cost of money flows through to impact the real economy. Okay, if you guys want to read this, I will link this PDF in the description, because I'm just perusing this on the fly and just seeing what's interesting to us. Because I find these documents where these venture capital groups are telling their founders, I feel like these are very high level documents and that there's no political spin to it. These guys just are in it for the money, and all they care about is how it affects their business. And so this is kind of as close to no spin economic information as I think we can get. Yes, we know that. So the Nasdaq drawdown has been huge. Well, this is the S&P 500, but we know from here to here, we've lost like 20% or more. It's been an extremely volatile 6 months in the tech market. Yeah, the Nasdaq graph looks even more volatile than that. At the high level, the market isn't as challenged as it was during the dot-com crash or the global financial crisis back in 2008. but the story underneath the surface is more revealing when you look beyond the mega caps. Okay, so they're saying it doesn't look as bad on the surface, but they think it's worse somehow. 61% of all software, internet, and financial tech companies are trading below pre-pandemic 2020 prices. That is interesting. A third are trading below COVID lows. Okay, so they're saying that a third of these stocks are trading below this point in the market, which is kind of crazy. I didn't realize that. Growth at all costs is no longer being rewarded. I don't know what EV stands for in this graph. Focus is shifting to companies with profitability. Okay, well that's bad for startups because almost all startups have no profitability, right? Cheap capital is not coming to the rescue. Unlike prior periods, sources of cheap capital are not coming to save the day. Crossover hedge funds, which have been very active in private investing over the last few years, have been one of the lowest costed sources of capital, are tending to wounds in their public portfolios, which have been hit hard. I don't know what a crossover hedge fund is. If one of you guys know, please comment in the comments and let us know. Many don't even have the capacity to invest, as the drawdown in their public portfolios has created an imbalance in their hybrid funds, where their private investments, which have been dramatically marked down, represent more than the maximum private capacity within their funds. Oh, okay. So I think this crossover hedge funds means hedge funds that invest both in private portfolios, like startups and venture capitals, as well as like publicly traded companies. Okay. So I guess they're saying that the private investments have not experienced the downturn that the public portfolios have done, but because they have to cover their public losses, they don't have money or liquidity to give more money to private. Yeah, yeah. Okay, so that's what this graph shows. That makes sense. Durable growth and improving profitably is always the path. Well, that's not that's not surprising, right? Okay, so this is the pain. So pandemic caused us problems, too much stimulus, war, supply chain issues, quantitative easing, inflation. So these are all bad. Yes, the only way to stop inflation is to stop purchasing. That is true. See, if we all stopped buying stuff, inflation would get controlled, and we do need to control inflation, but that causes economic downturns. All right, so they're expecting this kind of recovery. Who survives? Charles Darwin quote. You know, that kind of reminds me of the crisis quote. You guys remember this? Written in Chinese, the word crisis is composed of two characters, danger and opportunity. This is from a John F. Kennedy speech. Turns out that's completely wrong. That is a misunderstanding. It actually means danger and inflection point, not opportunity. Danger and like a fork, like a change in the direction of things. Like I just thought that was an interesting thing because I always heard that too, that crisis means opportunity and danger. I think we've all heard it, but turns out it's not true. Ah, yes. So this is, I think, hopefully this is a graph that Chris Anthony and Steve Fambro are looking at. So this is what they are saying is that here we are, and someone they need to cut costs immediately. and survive. Whereas if you don't cut costs and you have increasing expenses, you're gonna you're gonna run out of capital, and then you're gonna fail. Companies who move the quickest, have the most runway, are the most likely to avoid the death spiral. Do the cut exercise. Get rid of unnecessary R&D, marketing, projects, and other expenses. Don't view cut as a negative, but a way to conserve cash and run faster. In 2008, all companies that cut were efficient and better. Okay. Okay. What decisions do you plan to make versus what decisions do you wish you had made? I don't even know what that means. Okay, so when you have just 6 months of cash left, focus becomes incredible. Get that focus now, regardless of how much you have in the bank. Now, I have no idea how much cash Aptera has left. Remember, they needed another 50 million to make it to production, and I don't know how much of that 50 million they had already raised by that time from the SEC report. Um, but I assume they have about 6 months or less of cash left. That's my impression. And they do need an influx of cash, but maybe they do need to tighten their belt as well. I'm not sure. I don't know what their financial situation is at this time, and I don't think that they're talking about it either. I suspect it's not great though because everyone's having a hard time. Markets are doing bad, and Sequoia Capital is saying that it's a hard, tough capital market, and liquidity is not easy to come by. All right, so they're talking about opportunity. Okay, embrace reality. So the reality is the capital markets are tight. Adapt quickly. So they're saying that the pain of discipline, I think, which by that they mean cutting costs now, is less than the pain of regret, which is wishing you had cutting costs now. Then emerge stronger. hmm It is easier to preserve cash when you have more than 6 months left. Recruiting is about to get easier. Okay. I think this means that the labor market is about to get less tight. hmm Okay, the one who wins is the one who's most prepared. But how do you get prepared? Oh, there you go. They're going to answer it. All right, sure. That's like a lot of mumbo jumbo. Let's figure out what they actually mean. All right, here we go. Prepare your mind. Confront your reality. Okay, so yeah, you've got to confront the reality of your financial situation. All right, let's learn about Admiral James Stockdale. I never heard of this guy. He was the highest ranking U.S. military officer held as a POW during the Vietnam War from 1965 to 1973. He was tortured over and over again, but he made it out of there while many didn't. When you ask him who didn't make it out, he retorts, the blind optimists. They were the ones who said, we're going to be out by Christmas, and Christmas would come and Christmas would go. Then they would say, out by Easter, and then Thanksgiving, then Christmas. And they died of a broken heart. He would go on to tell many of his fellow prisoners, we're not getting out by Christmas. Deal with it. So he was a realist. And I guess he didn't make it out for 8 Christmases. Well, that is rough. Confront your fear. Now that you've confronted your reality, you have to prevent yourself from spinning into a negative cycle. Okay. So he just remembers when he was CFO of Link Exchange, they had tough times. Courage over fear. Courage is a decision, so choose courage. Okay. Crisis is opportunity. Ah, see, this is they're parroting the thing we just talked about. That's funny. Uh, Components are danger plus change point. JFK took. Oh, okay. Actually, they're saying it correctly. This is right. Components are danger and change point. That is correct. JFK took some license calling it danger plus opportunity. Now it's a very popular meme. Yes, this is correct. With a change point, the strong can become weak and the weak can become strong. The once coveted growth stocks are being dumped and the value stocks are being coveted. The slower growing companies that were doing it profitably now have the financial flexibility to take care of pullback from cash burning companies. That's okay. Prepare your team. This is really important to the missionaries you've hired. But you need to find people that believe in your mission. Yeah, mercenaries are the first. So those that are there just for the money, they're gonna leave. Uh-huh. Make sure you keep the missionaries. Mm, that's a good point. Know your audience, know your customers. That's us. Align your team. Ask for commitment. Hmm. Politely ask them to lighten the lifeboat. So we're gonna have to. So basically, I think what they're saying is you need to cut your employees, the ones that aren't committed to the mission and are willing to take some personal sacrifices. That's going to be a very tough conversation to have. Prepare your company. Almost every company had daily sales or metrics dashboard, but Zappos had a daily cash flow, and cash runway report because we almost went out of cash in 2001 and really helped us through the 2008 downturn. Create financial degrees of the best is to earn more from customers. Okay, so Aptera doesn't have customers yet, so they can't do that. Although I think they just need to make it to production really, really fast, as fast as they can, because then they would start getting some earning from customers. Improve your economics. So cut marketing, payback on the first order, cut access. Should have, okay. So Airbnb was forced to cut, Tell Me was forced to cut, Zappos were forced to cut. So yeah, because human resources is always the most expensive part of any company, usually. And so this is a terrible decision to have to let people go. If necessary, raise equity or debt, even if it's expensive. Yeah. So they're trying to raise. I think crowdfunding might still bail them out a little bit, but it's going to be tough. Okay, this is getting a little dense, and we're only halfway through this thing. I mean, you guys can stick around. I'm going to read this whole thing. If this is really boring, you guys should switch off and wait for the next video. I'm very interested in this personally, though. So I guess this was the Airbnb board update back in April of 2020. That's when the pandemic was full on and Airbnb was having a really hard time because probably no one was traveling. Once in a generation crisis, we need to make sure Airbnb is around for future generations. Okay. Play to win the 20. So they were hoping they were trying to make sure that they preserve cash, act with all stakeholders in mind. That means their customers as well as I guess their customers are actually Airbnb's customers are not really the renters. They're actually the people providing the Airbnbs. Okay, don't trade in the future. Okay. I don't know what this means. Don't trade in the future. We need to do four things: raise money, manage our stakeholders, diversify business, cut costs. Yeah. So I think this is probably what Aptera needs to do. Aptera needs to raise money, manage stakeholders, which are their customers or their investors and their supply chain people. They don't need to diversify because they need to be laser focused on delivering. They need to cut costs, more than likely. Change is inevitable, growth is optional. Yeah. This is the age of instability where managing change is everyone's job. Think of it as your personal assignment. If the world outside your company is changing faster than the world inside your company, the end is near. This is Jack Welch. If you guys don't know, that was the CEO of General Electric, which for a while was considered the most blue chip of all blue chip stocks. Leadership principles: communicate, conviction, confidence, calmness, be authentic, be human, balance optimism and realism. Okay. Strategies for uncertain times. Simplicity scales, complexity doesn't. I think this is where Aptera gets things right. Aptera is simple. Speed is one of the greatest business strategies. This is something I think Aptera needs to get to heart. Like, they need to move quickly on developing this thing, getting the prototype finished, and getting a production intent vehicle out there as soon as possible and getting this thing built. Double down on your top talent. Alignment over agreement. Tighten up value proposition to drive sales. Yes. If it's not one of these things, it's fluff. Drives revenue growth, saves money, reduces risk. The only way to drive revenue growth for Aptera is to deliver an Aptera. The only way to save money, I think, is to cut some staff and to accelerate development to get to production as soon as possible. The longer it takes to get to production, the more risk that they have. So motivational is pushing, inspirational is pulling. So I wonder what they're thinking is better. I guess they're thinking inspirational is better. No, oh, be both. Yeah, when given an option, choose both. Our intention in our gathering today is not to be a beacon of gloom. Far from it. We believe the best, most ambitious, and most determined of you will use this moment to rise to the occasion and build something truly remarkable. This was true for Cisco after the crash in '87, Google and PayPal in 2000 after the dot-com bust, Airbnb in 2008 in the midst of the financial crisis, DoorDash in 2020 during the health pandemic. But we believe that winning in the years ahead is going to depend on making hard, decisive choices, confronting uncomfortable challenges that may have been masked during the exuberance and distortions of free capital over the past 2 years. The primary goal of this session is to shift our collective mindset and the moment of uncertainty and change. All right. All right, so that's it. I thought that was actually pretty interesting. Um, Steve and Chris seem like smart guys. I'm sure that they're well aware of this, and I think that Sequoia Capital is right. I think they're right. I think that capital is going to get tight, and the economy is going to be pretty bad for the next several years, and it's going to be a tough time for all companies. I think Aptera has a lot of things going for it, but they're probably going to have to make some hard decisions and confront the reality that they're not going to be able to raise as much capital as they had planned on, because the capital raising that they've had over the past 2 years has been really, really good. I think Aptera has one of the best crowdfunded uh, fundraising rounds in the history of crowdfunding. So I don't think they can expect that to continue. and they need to make decisions accordingly. I really hope that they do. All right, well, I hope that wasn't a downer video for you guys. I just think that these documents that get leaked out um, that are from uh, people that are just doing finance without any spin and just want to do what's best for their companies are very interesting. Because, you know, we hear a lot of like uh, partisan political talk about, you know, quantitative easing and markets and the government's adding funding cash into the economy. But they don't care about the politics of it. They just want to know how it affects their businesses and how it's going to affect the financial outlook of the economy in the future. And I thought they had really good advice for their founders. Makes a lot of sense to me. Of course, I've never started a business, and I don't have any personal experience in it, but it just logically seemed to make a lot of sense, and I thought it was quite interesting. So if you guys made it through this long of a video with me, thank you for joining me on that. I will link the document in the description for you guys to look at, those of you who are interested. I'm sure this was a video that most of you guys weren't interested in, and you probably didn't make it this far. But if you did, here's our supporting members. Really appreciate them. Um, and we'll talk about some more normal stuff in the upcoming videos. Thanks a lot.